The purpose of today's program is to look into certain provisions of the Affordable Care Act dealing with employers. I suspect by this time any number of the folks on this call have already been to either one or more programs that talk about it. So I might presume some minimal level of exposure to these rules, but we'll try not to do too much so that everybody can follow along. Today I want to focus on two principal features of the law. The first dealing with the rules governing employers themselves. Those are referred to as the employer shared responsibility rules in the law, although in the media and elsewhere they're oftentimes called pay or play. The other rules we'll look at a little bit here are deal with reporting, how we tell the IRS about what kind of coverage we're offering, how we're complying or not. So I've set out on the agenda slide just kind of a roadmap of where we're going, and I'm going to try as we get to each node in the agenda to go back and remind us so that we stay on track. So we're going to start with just some preliminary items and definitions. And then we'll talk about applicable large employers, who they are, how you count heads to determine that, and then we'll talk about the penalties. And in the process, what I'd like to focus on is some compliance strategies. How are folks actually adapting to these rules? And in the case of folks on this call, what it means when you introduce a third-party staffing arrangement into the equation, because that's going to cause some issues of its own or bring some up. So I think I'm going the wrong way, pardon me. On the next page of the agenda, we're also going to talk about, we'll take a little bit of a deeper dive into how one counts full-time employees, and then we'll talk about some transitional rules and the like. So that's kind of where we're going for the next hour. So to begin, there are these rules called pay or play. They're referred to more technically, as I said, employer shared responsibility. And all they mean is that for the first time, a subset of U.S. employers, applicable large employers, are going to have to either make some offers of coverage, of group health plan coverage, or in the alternative, face the prospect of penalties. These rules were originally slated to go into effect in 2014, but they were subsequently delayed by the White House a little over a year ago, so that it's 1/1/15 is the general start date, although there are some transitional rules for folks with non-calendar year plans. In order to understand how these rules affect employers, we have to take a detour here because there are a couple of other provisions of the rules that affect how employers respond. And those provisions deal principally with something called the individual mandate. And that's the rule that says you and I, as U.S. citizens and green card holders, either have to have coverage or we face an individual penalty. So we have a choice. We can pay a tax or we can get coverage somewhere. It doesn't necessarily have to be for an employer. It could be from a public exchange. It could be from Medicare or Medicaid or some other source. There are also rules that deal with, and you'll hear this phrase come up over and over again, minimum essential coverage. And minimum essential coverage, this is a really misleading term in the rule because it has nothing to do with the content of coverage. Rather, minimum essential coverage tells you where you get the coverage. So if as an individual, if you and I get minimum essential coverage from an approved source, then we don't pay a tax penalty. And one of the sources we can get them from is an eligible employer-sponsored plan. And generally, an eligible employer-sponsored plan in the large group and the self-funded arrangements merely has to provide some kind of medical care. However, if you're buying coverage in the small group market or the individual market, the law is very specific as to what types of coverage you have to have. And there are 10 categories of coverage that have to be in those plans. Those 10 categories, referred to as essential health benefits, do not apply to large employers or to any employer that self-funds. There's also rules dealing with premium tax credits for low-income and moderate-income folks. The reasoning goes like this. If you're going to require individuals to have coverage, then for low and moderate income folks, you're going to help them pay for it. And you do that by giving them premium tax credits. Premium tax credits are only available when folks purchase coverage through a public exchange or marketplace. You can't get them from an employer-sponsored plan or elsewhere. But either way, and this is critical, you have to be between 100% and 400% of the federal poverty line to qualify. And then there's a distinction between the states that have accepted the expansion of Medicaid under the Affordable Care Act and those that don't. For now, we're going to sidestep that, but when we get at some examples, we might see that the bottom line, and that is that employers in states that do not accept the expansion of Medicaid are actually penalized. So it's a little slightly worse for them. So let's stop for a second. We've talked about some of the introductory material, principally how rules governing premium tax credits and the individual mandates fit into the puzzle. So let's turn now to employers. And the rules go like this. Employers, they're called applicable large employers, and they cover at least 50 full-time and full-time equivalent employees on business days during the preceding calendar year. So I want to point something out about this, is that for this purpose, for purposes of counting to 50, we're going to take into account not just our full-time folks, and that's going to be 30 hours or more on average per week, but also take a percentage of each of our part-time folks. We'll see it's a very different rule when we get to doing penalties. Also, it does include governments and tax exempts. A question we get all the time from our tax exempts, does this apply to us? Yes, it does. Similarly with government. The thing about applicable large employers is that in the vast majority of cases, a company will know for certain that it is over 50 or that it is not. For employers that are stuck in the middle, they're not quite sure, final regulations issued February of this year do a terrific job at telling each of us how to count to 50. So we're not going to spend a lot of time doing the mechanics of the calculations other than to look at how seasonal type workers are treated. But we won't go through the mechanics because, as I say, in most cases, you know already. One thing to keep in mind about counting to 50 is you have to include folks in the same control group as you. The control group, if any of you have 401k plans, then you folks have already encountered this rule. Because when you operate a 401k plan and you test it for non-discrimination, you've got to take into account related employers. That said, the rules governing who is in your control group or not are some of the most complex in the Internal Revenue Code. And they're getting a new look as a result of the Affordable Care Act when folks have to count to 50. But these are rules that generally govern two broad types of control groups. One is a parent sub, so an 80% controlled subsidiary is considered the same company as with the parent, or the same group that includes the parent. And then there are rules governing brother-sister corporations. And then the way you get there, the way you actually do the calculation is you do a month-by-month calculation for the calendar year, divide by 12, do some other adjustments, and voila, either you're at 50 or not. There are some rules about seasonal workers, and this is a narrow exception. And essentially, I'll give you the kind of a canonical example of these rules. If you're a small retailer, let's say, and during Christmas time, you're under 50 employees, but during Christmas time, you go out and you hire 50 or 60 more, and that would cause you to go over the 50, well over it. If it's less than 4 months, and these workers are defined generally as seasonal, there's something about their work that looks seasonal, then you're not penalized in the least. You're not going to become an applicable large employer. Now, so how did we've talked a lot about the fact there is a rule here, but what exactly is the rule? And the simplest way to understand employer shared responsibility is this. There are 3 options. Now, I know most folks who have been to programs like this before, sometime about this part of the program, the speaker will say, there are 2 taxes. There's A and B. And that's true, but I think there's an easier way to understand how these rules work, and that is to say that there are 3 options. So let's walk through what those 3 options are, and I think it should become pretty clear pretty quickly. So option 1. This is, under option 1, the employer has essentially said, I'm not going to offer coverage. And it might be, I'm not going to offer coverage at all. But if they fail to offer coverage to at least 95% of all of their full-time folks, and that's 70% for the first year. But if you fail to make that offer, then the penalty, and the penalty is under a provision of the code. It's section 4980HA, and so we call it the A penalty, and it's a stiff one. It's on an annual basis about $2,000 multiplied by all of your full-time folks, excluding the first 30. Well, see, there is a transitional rule here in the first year for large employers, where instead of 30, you get 80. But you get the idea. It's a big number because it's times virtually all your full-time folks. Some of you might recall that when the Affordable Care Act was first enacted, within a few months, there was a number of studies by very well-respected think tanks and consulting firms saying 56% of employers would drop coverage, or 28%, or some very large number. Those studies, in retrospect, were nonsense, because at the time we didn't know how the rules worked. We were still waiting for regulations. And indeed, the number of folks that have actually dropped coverage is, we've not seen one of our clients dropping coverage. And the reason is these penalties are pretty stiff, and also there are some very simple ways to sidestep this particular penalty with a very inexpensive plan from the employer's perspective that we'll talk about. So that's option one. Option two is you do make an offer of coverage, but the coverage is less than adequate. Let's call it not all that good. And we'll talk about what that means in a second. But there, the penalty is $3,000 on an annual basis, multiplied by just the folks that qualify for a premium subsidy. Well, if you think about it, that a lot will depend on the demographics of your company, because premium subsidies can only be awarded to folks who are above or in between 100 or 133% of the federal poverty line. That's around 11,670 at 100%, and about 16,000 at 133%, up to about $40,000. So if you have a lot of very high-paid folks, even if you didn't offer coverage, they couldn't get a subsidy. And when there is no subsidy, there is no penalty. Similarly, if you have large cohorts of folks who are Medicaid eligible, who are at or underneath the 133 or the 100%, if you don't offer coverage, but all of your employees were like that, you couldn't incur a penalty. It's only when some employees are within that range and can qualify for a subsidy that you actually trigger a penalty. For this option two, we're really saying that this is a middle ground between pay or play. And when we talk about the compliance strategies, you'll see a good use of how this would come into play for particular employers. Option three. Well, before we get there, though, I did say that in option two, we're going to make an offer of coverage, but that coverage is inadequate. Coverage is inadequate if one of two things happens. Either it's unaffordable or it fails to provide minimum value. Affordability is pretty simple. If you look at the employee contribution for self-only coverage, and I want to emphasize, it doesn't matter if the employee is married, has a family, whatever, they need family coverage. For purposes of these rules, you only look at the coverage that for individual coverage, and you ask, is it at or below 9.5% of the employee's household income? Well, how do you know what household income is? And the IRS has recognized that it would be very difficult for employers to know that, and therefore they've given you an option, or three options actually. Three ways that you can determine household income without having to ask the employee for tax returns. The first is you can use the W-2 wages safe harbor. Now, this, as the name suggests, you look at what the individual made for the year, and that's affordability. The problem with that safe harbor, of course, is you don't know for certain what the W-2 income is going to be until the end of the year. So this is only useful, this safe harbor is only useful in instances where you have very stable working relationships. You know from year to year what your employees are going to make. The next safe harbor, and probably a much more useful one where hours vary, is the hourly rate of pay. You just simply look at what the employee makes per hour, and you multiply it out times 130 hours a month for the month, and then annually times 12. The last safe harbor is it assumes that everybody makes the lowest amount specified by the federal poverty line. Well, that's 11,000 for this year, 11,670. That's a really reliable safe harbor. It gives you a number that you can take to the bank. The problem is that from an employer's perspective, it's going to cost you more to use that safe harbor, because instead of using actual income, you're assuming that everybody is at the very bottom. But it is an option. Our next slide, a little bit of a delay here. Remember I said that there are two things that make coverage inadequate. Either it's not affordable, we just covered affordability, and then there's the question of minimum value. And this is something that has folks scratching their heads, so we'll spend a few minutes explaining exactly what it is. But the issue has also come to light recently because there are some plans that do provide minimum value based on the criteria specified by regulators, and yet have a shockingly bizarre plan design. They eliminate coverage for all inpatient hospital services. Kind of strange. So what is minimum value? Minimum value is a close cousin of a term called actuarial value. It is simply a measure of how generous the plan is. The only difference between minimum value and actuarial value is what population you look at. For employers, when we're looking at minimum value, we look at average large self-funded plans. And for actuarial value, we look at entire populations. And the way it works is this. Actuaries can tell us with pretty good accuracy what it would cost to cover, let's say, all of the individuals in the state of Virginia, just to pick a state. And you can ask the question, if we were to cover every expense, every medical expense for all of those folks with no copays, no deductibles, no co-insurance or cost sharing, what would that cost? Top line number. Divide that by the number of folks, and you get a 100% actuarial value plan. Very generous, no cost sharing. Well, you can back that down. Instead of paying for all the covered services, what if we only covered 90%? And that would leave 10% to be paid by cost sharing, copays, deductibles, and the like. We can back that all the way down to 60%. Now, when we get to 60%, 60 cents on the dollar of benefits is being paid by the by the plan, and 40% are being paid by the employee. That's not a very generous plan, but that is the minimum level necessary in order to pass muster, that is to provide a plan that provides minimum value. To put it in perspective, if folks on this call have, if you've been working in the workforce for a while and you've relied on your employer to provide you coverage, and let's say you have a plan that comes through, I don't know, Cigna, Aetna, Blue Cross Blue Shield. In Massachusetts, it might be Tufts. The typical PPO plan that you and I have become very accustomed to is somewhere between 85% and 92% actuarial value. So that'll give you a sense of how generous you need to be. 60% is a far less generous plan than that, and it will still pass muster under the law. What that means, by the way, is if you offer a plan that provides minimum value, and if it is affordable, then employees are what is called firewalled from getting a premium tax subsidy. They are barred. So even if I'm a low-income person who would otherwise qualify for a premium subsidy, if my employer offers me coverage that is both affordable and provides minimum value, I'm denied the subsidy. Well, remember what we said earlier, where there is no subsidy, there is no penalty. So let's go to our third option. Remember we said that under the law we have two sets of coverage, and actually we're going to come back to hours of service before we get to our third option. But we have two layers of coverage. One is we don't offer anything, and we're going to have a very big penalty. Two is we offer coverage that's less than adequate, and that's going to be something less of a penalty. And we're going to head to our third option where we offer generous coverage. But I need to take a little detour here because this is going to surprise some employers. What about hours of service? We mentioned earlier that the measure is 30 or more hours of service. So how do we count an hour? Well, for folks who have maintained retirement plans, the definition of what constitutes an hour of service has been around for a long time. And it's a definition that the Department of Labor came up with back in 1978. And it says that you count not only an hour that is worked, but you also count an hour for which somebody is paid but didn't work. So that might be paid leave, could be paid vacation, might be bereavement, any instance like that. Those hours all count when you're counting to 30. And then there are some rules about you can use 130 hours of service in a calendar month rather than 30 hours a week. It's simply an equivalence. Fortunately, however, hours of service outside the United States aren't counted. So if you have folks that are working offshore, they're not going to end up subject to these rules. And you can use actual hours from your records, or you can use some equivalencies that I'm not going to spend a lot of time on. You also don't count hours of bona fide volunteers. This rule is really driven by volunteer firemen, because even though they're quote-unquote volunteers, they are paid for some of their time, or at least reimbursed for expenses. Similarly, students on the federal work-study program and certain religious that probably won't involve folks here. So let's go to our third payment option. We said under the option 1, we're going to pay a big penalty. In option 2, the penalty is going to really depend on the demographics of our workforce. If we've got a lot of folks who could trigger a subsidy and we offer coverage that is not affordable or fails to provide minimum value, we might have some substantial exposure. Otherwise, not. But our option 3 is we're going to make an offer of coverage, and that offer is both affordable and provides minimum value. Well, that's terrific because our penalty is 0. Now, if you think about it, what's the difference between option 2 and option 3? The difference is there's going to be some cost to the employer, some perhaps increased or most likely increased cost to do option 3, because you're going to have to offer a plan that is fairly generous, and it's going to have to be made affordable. There are a good number of calculators out there that allow employers to model this stuff, to be able to make some educated guesses about take-up rates, things like that, and say it would cost us X number of dollars to pay penalties, and it would cost us Y to offer coverage that's affordable. What do we like better, X or Y? In fact, probably one of the best places to start when trying to comply with these rules is to model it and see what your options are as an employer. So up to now, we've really talked about what the rules are. And as I said earlier, if you've been to any sort of program on this or read about this, you've probably encountered all of what we've talked about up to here. But the question is, what do you do to comply? So now you have your employer, you've decided that you're over 50, you either know it or you've gone to the regs and you've found out how to count to 50, and you say, we got to do something about this. Well, what are our options? One option, and this option, it took a while for this to filter into the mainstream, but it's something called a sub-minimum value plan. Remember I said that coverage is, that an eligible employer-sponsored group health plan is a plan that simply offers minimum essential coverage. Minimum essential coverage is what I need as an individual not to pay a tax. But so what might a minimum essential coverage plan look like in a large group market? Well, the answer is, surprisingly, all the plan has to do is offer something that looks like medical care other than what is referred to as an accepted benefit, standalone vision or dental or hospital indemnity or something like that. So the solution that the industry has come up with is to offer a plan that covers only preventative care. That's it. Covers nothing else. Now, most of these plans are marketed with perhaps a wellness program, and they're also offered with coverage that looks like AFLAC coverage, the per day of hospitalization and things like that. But all it really needs to include is preventative care. It was called a skinny plan originally. The regulator started referring to it as subminimum value, but now the industry is referring to it as simply a MEC plan. This is a self-funded plan, and it provides only preventative services and some, as I say, non-coordinated hospital indemnity feature. What this does, it's hard to underestimate the importance of these plans, as bizarre as they might sound, because it completely gets an employer off of the A penalty, the worst penalty, by offering coverage that it's not very good, and you can charge the employee the full amount of the premium, which is usually very low, about $70 a month. No A penalty. So therefore, in my view, the A penalty has become something of an IQ test for employers. Only employers that are dumb enough not to go out and find one of these MEC plans are going to pay it. And there's plenty of vendors out there that are offering these things. They're self-funded. They don't have to go through state insurance commissioners. The other strategy, assuming that you're not going to pay the A penalty at all, is do you want to drive down the cost of the B penalty? The trick there is to reduce the aggregate premium cost of a plan so that affordability is also diminished. So if you go out and get on the open market, a Blue Cross Blue Shield plan, a typical one today, the premium cost for individual coverage is probably around $500, $600. So what if you, instead of paying $500 or $600, you could find a plan that cost half that per month? Well, the cost of offering affordable coverage would be cut in half. And these plans do exist. They are plans that have been marketed. They're self-funded. And what they do is they have the look and feel. They look like a normal medical plan, but they carve out all inpatient hospital services, which is where the big money is. The reason that they work, these may be lousy plans, but they work because the Department of Health and Human Services, which the Act says writes the rules about minimum value, says we're going to give you an online calculator. And if you get to 60% using that calculator, then you provide minimum value. Well, lo and behold, you plug these things into the calculator, and you get 60.5%. You win. These plans have stirred some controversy because folks are saying, how can this possibly be, especially some actuarial groups, and they ought to know. There's some fear that there's something wrong under the hood of the calculator. What that means as a practical matter is these plans might work well for a year or two, but ultimately they might go away. Another approach that folks are using is plans with limited networks. These work great in large urban areas where it's not difficult to craft a limited network. They're a little trickier when you get to plans that are in rural areas where you just can't, where there might be only one network in the area. So instead of being able to go to any hospital you want, you might be limited to a few or a handful. And these can be either self-funded or fully insured. So those are some of the compliance strategies that are hanging around out there. Of course, you can always just stick with whatever your current major medical offering is, expand it to your whole workforce, run the calculations, determine what it costs, and be done with it. And these slides really just expand upon what we talked about, so I'm going to skip over them in the interest of time, but they just flesh out the two strategies that I spent the most time on. We mentioned earlier that a full-time employee is one working 30 or more hours a week or 130 hours of service in a month. One of the problems that has come up in three-party arrangements where folks use staffing firms is, whose employee is it exactly? That is, if you retain an employee from a staffing firm, is that employee the client's employee or is it the staffing firm's employee? And here I'm going to just skip to I'm going to skip over the measurement methods because broadly there are two ways to handle determining who's full-time. The one that is being used in most instances is called look-back measurement, which allows you to hold people out for a while if you don't know whether they're full-time. And that can happen a lot in some staffing settings, but not others. But what I want to do is get over to the slide that's going to deal with pardon me for a second. We're going to have a slide that talks about the staffing industry in generally and how clients might use staffing firms. Bear with me. I'm just noticing that the time is going by a little quicker than I thought, and I know we have this slide in here. Well, somehow that slide did not make it in, so I'm going to have to explain it to you. My apologies. Very simple. When a client organization hires a staffing firm for years, going back to World War II, in fact, the staffing industry and clients have pretty much assumed that employees that you retain through staffing firms are the common law employees of the staffing firm. And that rule has been followed for as long as at least I can recall. Along comes this rule. Along comes the Affordable Care Act, and all of a sudden it becomes a little more important to determine whose employee it is. The issue is this: what happens if you have, and let's take an example. You start with an employer of 300, has 300 employees. They then, for some reason, payroll or hire off 100 of those employees through a staffing firm. The staffing firm makes an offer of coverage, let's say it's minimum value, and provides, and it's affordable, no penalties. Staffing firm is fine. Later on audit, the IRS comes in and says, well, what if we disagree? What if we think those employees are really the common law employees of the client? Well, then the client has now, if it offers coverage, has made an offer of coverage to 200 out of 300. That's not enough. Client had thought that they were in good shape. Turns out that they weren't. There is the final rules recognize this problem. And what they say is they allow offers of coverage by unrelated employers. In English, it simply means that you can, under certain circumstances, get credit for coverage that is offered by the firm. Now, this does take some manipulation of the staffing contracts themselves, but it's not all that difficult. So at the end of the day, the IRS has recognized that there's a problem and that they've given us a way to fix it. The last part of the program that I want to look at here is it has to do with a class of employees that are called variable hour. It's one thing, we've said that we're only going to look at full-time employees when we're doing our calculation of penalties. And that's, in some industries, that's all you have. You might have a large workforce of stable employees. Everybody's full-time. They're all over 30 hours. They've been that way historically. You've routinely provided benefits to them. For employers like that, these rules are going to be something of a speed bump. Nobody's going to be too concerned about them. Similarly, if you have employees that you hire, a group of employees that are truly part-time, they work 10 hours a week, 15 hours a week. Never go beyond that. They're not going to give you a problem. Then you don't have to make an offer of coverage to those folks. It's not an issue. But what happens when you hire a person who you just don't know what their hours are going to be from week to week and month to month? Let's take an example. You're a regional restaurant chain, and you operate in resort areas. The week before the 4th of July, you hire a bartender. 4th of July week is beautiful weather. The place is crowded. The bartender works 80 hours. The next week, everybody goes home. It rains. The bartender works 20 hours. That's classically what the final rules refer to as a variable hour employee. And a variable hour employee, for employers that have a lot of those folks, they get a good deal if they use the measurement method that I just referred to earlier, the look-back measurement method. And what it allows them to do is to pick a measurement period. It can be up to a full year. and you don't have to make an offer of coverage during that year, and you don't get penalized. At the end of that year, you then ask, you look back and you say, did they really work 15, 60 hours? Did they work on average 30 or more hours a week? If the answer is yes, then you simply offer them coverage for another stability period that's around the same length as your measurement period. So the way the deal works is you get a year off, but then you must cover them if they were full-time for the following full year, even if their hours don't stay up. They vary. This particular measurement method is, as I say, I think most folks are picking up on it, or at least those that have any sort of variability in their workforces. That same sort of treatment, that variable hour treatment, is also accorded a couple of other categories of employees. For example, if you have seasonal employees. Now here, the term seasonal employee is different from seasonal worker. When we were counting to 50, we looked at who was a seasonal worker, and that's a much narrower term. A seasonal employee is any employee whose customary employment is less than 6 months. And it's unrelated to the weather. So for example, and I didn't know this until I started working with these rules, the auto industry has a peak hiring season that starts late fall and goes for about 4 or 5 months. Employees that are brought on board in that peak season might very well be seasonal employees. The reason is their customary employment is less than 6 months, and there's something about that particular job that is seasonal in nature, other than weather. It's a production cycle. So they can be treated the same way. You hire somebody who is seasonal. You don't have to offer coverage right away. You can provide them with, you can hold them out, test them during a measurement period, and then if they are full-time after the end of the measurement period, you can then give them coverage during a stability period. Curiously, part-time employees are also tested under these rules. Now, if somebody is truly part-time, it doesn't matter because you're not going to end up having to offer them coverage. But if your part-time employees were traditionally, instead of 15 hours a week, what if they straddle the 30-hour limit? Sometimes 28, sometimes 33. So an employee like that could very well end up being offered coverage in the following stability period. Now, I'm wondering, I can't tell if I'm still connected.
Alden, we can hear you.
Hello?
Yes,
Hello?
Alden, we can hear you. Keep rolling.
Oh, good. I thought I had lost you. My apologies.
No.
All right.
All good. Thanks.
There for a second. I didn't hear anything. Okay, good. So what does this all mean for compliance? So for employers, and as I think I alluded to earlier, you can carve yourselves into a bunch of different employer-type units. As I said, there are two methods. The method that if you are a large, stable employer with a stable workforce that you traditionally offer coverage, then none of these rules are going to be too much of a concern for you. But if you do have variable hour and other type folks, they'll mean a great deal. So where does this all leave us? What do you do going forward? I'll talk a little bit about when the rules become effective and how we transition from not having to comply with these rules to complying with them. The rules generally go into effect January 1 of 2015. It is not plan years necessarily. The statute itself says you start on January 1. That for employers that are offering coverage already, however, and if you offer coverage to a large group of your employees, not just a small cohort, then there are rules that allow you to defer the commencement of your coverage. Instead of January 1, you can look to the first day of your calendar, of your planned year. And this has caused a lot of confusion. The question is, what's my planned year? For a plan that is over 100 employees, the answer is you look to your IRS filing, the Form 5500. In the very top of the first page of the form, it'll tell you what your plan year is. What we've seen, the mistake some folks are making is they assume that your renewal year is the plan year. That is the year of your insurance contract. Those aren't necessarily the same things, so that you could get yourself in trouble if you make that mistake. So if you're going to use that transitional rule, the first thing you want to do is determine what your plan year is. The second thing to do is determine if you qualify. So the way you do that, there's two ways. One is, did you make an offer of coverage to a third of all of your employees? And that's full-time and part-time. So that's only good for some kinds of employers and not others. Or did at least 25% of all your employees accept your offer of coverage? Either one of those will get you to use that transitional. Very valuable. Secondly, you can use that transitional rule looking only at full-time employees. But there you have to make an offer of coverage to 50% or more, or 33% have to take you up on your offer of coverage. So if you meet either of those standards, you can take advantage of that rule, and that means instead of being tested as of January 1, you're going to be tested as of the first day of the planned year. Then the next question is, once you do, and I'm sorry I'm not keeping up with the slides here. My apologies, we're going to move that along. But then the question is, how do you report all this? How does the government know what you're doing? And the answer is that we've recently, and this is in the last couple of weeks, we've gotten two sets of rules having to do with how you tell the government what's up. One set of rule has to do with carriers, so it's aimed at the insurance companies themselves. The other set of rules is aimed at employers. That first set of rules, even though it's aimed at carriers, also picks up self-funded plans. So if you have a self-funded plan, you're going to report under both parts of the statute. We have some model forms now, some draft forms, so we don't know exactly what they're going to look like yet, but we have a sense of what they're going to look like, and we have some draft instructions. What's going to happen is, first of all, we don't have to worry about this until we get all the way through 2015, and then the reporting takes effect within the first few months of 2016. The problem is that employers need to start now to collect the data that they're going to need in order to report on how they are complying. So they're going to need to be able to report whether or not they have provided a minimum value coverage, whether or not they've made it affordable. They're going to have to tell us how many people they covered. Did you get to 95% or 70% in 2015? And we're also going to have to let the IRS know a little bit about our workforce, how many people are involved, how many are part-time, things like that. What we're seeing on the ground is that there are any number of vendors. For example, and I point to both the two big national vendors, Paychex and ADP, that have done a terrific job at understanding these rules and getting the word out. Then there's a whole host of other vendors that come on the scene either through the major national carriers or consulting companies. And again, folks seem to, the professionals that are charged with tracking these seem to have really understood the rules and endeavored to make it available to folks. But, and here's the big problem, all of these vendors are saying we have the software, you can look at the design parameters of the software, and you can make a call as to whether or not you think it works. Most of the ones that I've seen do. But until we get to next year, we don't know if those programs are going to work. My sense is they will. We now have enough of an idea of what the IRS wants so that the folks that actually program these actually create this software, they have their design parameters. And so we're hoping that it all goes smoothly. But I do want to emphasize, these reporting rules are very burdensome. They require a lot of information. And most important, they require it broken down month by month. And the reason they require it month by month is that's the way the statute's written. It's written to apply month by month. So what does all that mean? Well, let's sum it up. We're getting close to the end of our hour. I think step one is, are you an applicable large employer? Do you have to worry about these rules? We hope that in most instances you do, but there might be cases where you don't. We've got real solid rules to get you there. Two is, how are you going to comply? In contrast to what happened back in 2010, it's pretty clear now that employers are going to make some kind of offers of coverage. That is, they're going to either make coverage available that's inadequate, or in face exposure to some penalties, or they're going to do something different. They're going to offer affordable coverage, provides minimum value, and drive the penalties to zero. That requires some advanced planning. People need to start to make some guesses because that's the only way you can model this stuff now. And the rules have not been enforced, so we don't know what it's like in the real world. And decide how they're going to comply. And then I described some of the major compliance strategies out there. And just to sum up, obviously, if you're already offering coverage to most folks, it's not going to be an issue. If you don't, then there are going to be some design options that are now coming online.